Here is what is happening right now and why the next 72 hours are absolutely critical for anyone holding silver or watching the markets. The COMEX is facing a liquidity squeeze that historical data suggests happens only once every few decades, and the numbers released this evening confirm the worst-case scenario for paper manipulators while painting a bullish picture for physical holders. 33 million ounces of silver have been pulled from registered vaults in just 7 days. Let that sink in for a moment. That is not a typo. That is not a gradual decline. That is a violent, accelerated evacuation of physical metal from the system that is supposed to guarantee delivery for the futures market. To put that into perspective, that is roughly 10% of the total remaining registered inventory gone in a single trading week. If you are wondering why this matters, it is because the coverage ratio, the amount of physical silver available to cover paper contracts, has now collapsed to a level where even a modest delivery demand could trigger a force majeure or a default event. This is the data point the mainstream financial media will ignore until it is too late. But you need to see it now. JHON AG here. And as we head into the weekend of February 14, 2026, with markets in the US closing for the night, and traders in Asia preparing to open their Monday session, the setup we are witnessing is unlike anything we have seen in modern history. We need to look at the exact mechanics of what just happened over the last 5 trading days leading up to Friday the 13th. The CME Group Vault reports, which are released with a 1-day lag, have been showing consistent draws, but what we saw this Friday evening in the US was an acceleration that caught even the most bearish analysts off guard. We started the week with registered silver sitting roughly around 98 million ounces. We are now closing the week, according to the latest preliminary reports verified against the daily vault notices, at approximately 65 million ounces. A drop of 33 million ounces in 1 week is not normal industrial demand. That is not someone buying a few thousand ounces for minting. That is a systematic takedown of inventory, likely by a concentrated entity or a syndicate of entities demanding immediate allocation. When you see numbers like this, you have to ask the question, who is taking delivery? Because the counterparties on the other side of these trades, the ones guaranteeing the metal, are scrambling. This is not just a number on a screen. This represents a failure of the paper price discovery mechanism to adequately price in the scarcity of the physical asset. Now let's connect this to the price action we saw this week, because the divergence is the key to understanding the manipulation. While 33 million ounces were being drained from the vaults, the paper price of silver on the COMEX was heavily suppressed, trading down towards the $74 to $75 range, closing the week effectively flat or slightly down, attempting to paint a picture of weak demand. This is the oldest trick in the book. The bullion banks use the futures market to smash the price, hoping to trigger stop losses and induce panic selling among leveraged longs, thereby generating paper supply to offset the physical demand they cannot meet. But the physical market is screaming the opposite. You cannot hide the inventory data. It is publicly available, it is verifiable, and it shows a market that is bleeding out. The disconnect between the paper price and the physical reality is now at a breaking point. We are seeing a situation where the spot price is effectively a fictional number used for derivatives trading, while the real price of acquiring physical metal in size is completely different. If you are a regular viewer here, you know I do not sell fear, I sell data. And the data right now shows a structural deficit that cannot be fixed by algorithm trading or lowering margins. The reason this is a COMEX crisis is purely mathematical. We have to look at the open interest for the upcoming delivery month, which is March. As of Friday's close, the March open interest remains stubbornly high. We are looking at roughly 50,000 to 60,000 contracts still outstanding for March delivery depending on the rollovers processed today. Each contract represents 5,000 ounces. That represents a claim on nearly 300 million ounces of silver. But remember, the registered vaults now hold only about 65 million ounces. That is a coverage ratio of nearly 5 to 1. That means for every ounce of silver available, there are 5 paper claims on it. In a normal functioning market, this ratio might be manageable if everyone rolls their contracts to the next month. But in a market where we just saw 33 million ounces walk out the door in 7 days, the odds of everyone wanting to roll are decreasing. The holders of those contracts are likely aware of the inventory drawdowns. They see the weakness in the system. They are more likely to stand for delivery, demanding the metal rather than rolling the paper forward. If even a fraction of these contracts stand for delivery, say 20%, the COMEX does not have the metal to satisfy the claims. This is the definition of a short squeeze in the physical realm. The shorts, the banks who sold the paper, are trapped. They have to deliver metal they do not have, or they have to buy back the contracts at higher prices, driving the price up violently. Now let's look at the global context, specifically the Shanghai Futures Exchange (SHFE), because the East is playing chess while the West plays checkers. The Shanghai Premium, the difference between the price of silver in Shanghai and the price in London or New York, remains elevated. We are seeing premiums of $3 to $5 per ounce, and often spiking higher during the trading day. This indicates that physical demand in Asia is voracious. They are not interested in playing the paper suppression game. They are importing metal, draining the global supply chain. The massive inventory drop we saw this week likely has a significant Eastern footprint. When the markets open in China on Monday morning their time, which is Sunday night here in the US, they are going to see the COMEX inventory numbers. They are going to see the desperation in the West. They are likely to bid the price up aggressively. This creates a scenario where the Western market opens on Monday, February 17th, after the President's Day holiday in the US. Wait, actually, checking the calendar for 2026, President's Day is Monday, February 16th. If the US markets are closed on Monday, the trading will be thin, but the pressure will be building for Tuesday. However, the Shanghai market will be open Monday. They will have the entire day to react to this 33 million ounce drop without the COMEX being able to intervene. That is a dangerous setup for the shorts. The price discovery could shift entirely to the east while the US is on holiday, and when the US markets reopen, we could see a massive gap up. We also need to discuss the geopolitical element that is fueling this run on metal. We are in an environment where trust in the dollar-based financial system is eroding daily. The BRICS nations are actively de-dollarizing their trade. Just this week, we saw further moves by central banks to diversify reserves away from US treasuries and into hard assets like gold and silver. When countries like China, Russia, and India accumulate silver, they do not store it in COMEX vaults. They move it to their own sovereign vaults. They take it out of the system. This week's 33 million ounce drop could very well be a sovereign transfer. This is the great migration of metal from west to east that we have been warning about. The COMEX is slowly but surely being hollowed out. It is becoming a shell of an exchange, offering paper derivatives that are increasingly disconnected from the physical reality. For the average investor watching this, the lesson is clear. You cannot eat paper. You cannot take delivery of a futures contract unless you are a whale with a vault arrangement. The average person needs to secure their own physical allocated metal before the system locks up. The signs of a liquidity lockup are flashing red. The coverage ratio is at dangerous lows. The inventory draw is accelerating. The premiums on physical retail coins and bars are likely to rise sharply next week as dealers realize the shortage at the wholesale level. I want to take a moment to address the new viewers in the audience. If you are checking the description or the comments for financial advice, you won't find it here. I do not sell signals or memberships. I provide education based on raw data and tape reading. If you verify this data yourself by checking the CME Vault reports, you will see the numbers align. If this kind of unfiltered analysis gives you clarity, drop a comment below with OG JHON AG, so I know who is actually doing the work and paying attention versus who is just scrolling for entertainment. That interaction helps build this community and ensures I keep bringing you the truth, no matter how ugly it gets. Now, back to the mechanics of this crisis. The move we saw this week was likely a coordinated effort to shake out weak hands before the delivery month begins. The banks smashed the price hoping to trigger stops, but the inventory data proves that someone was buying the dip aggressively in the physical market. This is the bifurcation event. Paper price goes down, physical availability goes down, and physical premiums go up. It is the ultimate trap for the paper traders. They think they are shorting a commodity that is falling in price, but they are actually shorting a commodity that is vanishing from the face of the earth. When the realization hits, the reversal will be swift and violent. Let's look at the technical levels for next week as we head into this critical window. Support for silver paper price sits at that $74 level we have discussed in previous updates. It has been tested repeatedly, and so far it has held. However, with the massive inventory drop, the fundamental floor has just risen significantly. Technically, we are coiling. The Bollinger Bands are tightening. The 150 exponential moving average is acting as resistance around the $81 mark. A break above $81 on high volume, which could easily happen if the Shanghai market spikes on Monday, would confirm the breakout. If the paper manipulators try to smash the price below $74 next week, they risk triggering a buying frenzy from the physical side. It is a checkmate scenario. If they push the price down, it becomes too cheap relative to the physical scarcity, and the drain accelerates. If they let the price rise, they blow up their own short positions. They are trapped in a box of their own making. The volatility we are seeing is a symptom of this trap. The whipsaw action, where the price drops $2 in minutes and then rallies back, is the battle between the paper algorithm sellers and the physical buyers stepping in. We also have to factor in the broader macroeconomic backdrop. The Federal Reserve is in a difficult position. Inflation data is sticky. The dollar is struggling to maintain its strength against a basket of currencies. When the dollar weakens, precious metals naturally strengthen. But we are seeing a scenario where metals are strengthening against the dollar, even when the dollar is relatively strong. That is the safe haven bid coming into play. People are buying silver not just because of dollar weakness, but because of systemic risk. The banking system is showing signs of stress again. We saw credit spreads widen slightly this week. We saw the yield curve do some strange movements. These are early warning signs of a liquidity crunch. In a liquidity crunch, cash is king initially, but hard assets become the ultimate survivors. The 33 million ounce drop is a vote of no confidence in the counterparty risk of the COMEX. The entities taking delivery are saying, "I don't trust you to hold my metal. I am taking it somewhere safe." This is a run on the bank, plain and simple. It is 2008 all over again. But this time it is the commodities warehouses that are being run, not just the depository banks. For those of you tracking the specific vault data, the majority of this drop appears to have come from the JP Morgan and Brinks facilities. JP Morgan has historically been the custodian for the SLV ETF and a major player in the silver market. When you see their registered category drop significantly, it raises questions about the flow of metal from the ETF into the futures market or into private vaults. We saw the SLV shares outstanding drop slightly this week, but not enough to account for this massive a drop. This implies the metal is coming from the registered stocks that were specifically earmarked for futures delivery. This is the registered category we watch so closely. When that goes to zero, the game is over. We are not at zero yet, but 65 million ounces is dangerously low for a market of this size. It represents roughly 2 weeks of global mine supply. 2 weeks. That is the buffer we have left for the entire Western paper trading system. It is absurd. It is negligence on the part of the regulators to allow this leverage to build up while the physical buffer evaporates. As we look ahead to the publication of this video, on the morning of February 14th in India, which is the evening of February 13th in the US, the traders in Asia are waking up to a completely different landscape. They are seeing a COMEX that is on the ropes. They are seeing an opportunity to break the paper suppression scheme once and for all. I expect heavy buying in the Asian markets on their Monday open. If the price gap's higher, the COMEX shorts will be margined out immediately when the US markets eventually reopen. This could be the trigger for the long-awaited reset. The next 5 to 10 trading days are going to be historic. We will likely see increased volatility, wider premiums on physical retail products, and a potential scramble for metal that creates headlines in the mainstream media. By the time the average person reads about it in the newspaper or sees it on cable news, the move will have already happened. The time to position yourself is now, before the market opens on Monday in the East. So here is the summary of the situation we are tracking. The COMEX registered silver inventory has crashed by 33 million ounces in a week. The paper price remains suppressed below fair value. The physical premium is expanding. The coverage ratio is under severe stress. The shorts are trapped. The Eastern markets are preparing to bid the price higher while the West sleeps. The data is verifiable and undeniable. This is not a drill. This is the financial reality of 2026. Keep your eyes on the vault reports next week. Watch the open interest numbers for March. If they do not decline rapidly, the squeeze is on. If you are positioned in physical, you hold the insurance. If you are trading paper, be extremely careful with your stops. The moves will be violent. Trust the data, verify the facts, and stay grounded. OG out and about.